The casino itself is bankrupting. So what you need to do is you need to cash your chips in now, get those chips out of the casino and out of chips. You got to convert your chips into something real. And that's basically, you need to convert your fiat currencies to gold and silver. Because the analogy of the casino being bankrupt, you've got sovereign treasuries all over the world that are upside down. This is for non-IRAs. In an IRA, you've got to do a product that's 99.9 pure. Mm-hmm. Junk silver, I've been an advocate of junk silver for the last 10 plus years now. It's the smallest denomination of silver. In other words, 14 dimes equals 1 ounce. I think it's $1.38 equals 1 ounce. Mm-hmm. So that gives you 14 transactions. In a system down scenario, if you're going to barter, now you've got the smallest unit of silver. It's recognizable because everybody knows what a dime or quarter looks like. And as long as it says 1964 or earlier, you know it's 90% silver. It can't be counterfeited, because if somebody comes to you with a bright, shiny, brand new dime or quarter, it's probably fake, because junk circulated for years and years and years. It was in people's pockets. It should be scratched. It should be dirty. And on top of that, it is U.S. mint lineage coin. Now, the reason I wanted to talk today about junk is because the pricing on junk versus other forms of silver have temporarily collapsed. I think dealers are bidding $4 and $5 under spot if you go to sell it. And you can buy it at spot, maybe 25, 50 cents over spot. It's the cheapest form of silver available right now. The reason being, back in the late 70s and the early 80s, I'm not going to say it was the only means, but the primary means of Americans that wanted to buy silver, the junk silver, that was really all there was available for investors. So you had, I don't know, well, you've had years since then too, but you had 5 or 10 years there where people were accumulating silver. They saw the $50 peak. You had some buyers, of course, at that level or in the 40s, and they hung on for 20, 30 years plus. What's happened is a lot of that legacy silver, when the price got to $50, people started selling. People and large hoards have been sold. What's happened is the dealers don't want to hold all of that as inventory. So if they're bidding 5%, 7%, 9% under spot, they take that junk in, they send it to a refiner, they refine the silver out of it, and then they sell that silver on the spot market, and that's how they make their profit. The problem long term, now this is a short-term problem, because refiners are backed up. Some refiners are even refusing to take more junk in. They're backed up. But once this backlog gets done, the discount will abate. It'll come back to spot or above spot. And going forward, there's way less junk silver left in existence because it got melted down. So if you're buying silver today and it's not an IRA account, it's foolish to not buy junk silver. It's the best form for an American to own, and it's the cheapest. The most readily recognized form of silver that has proof positive that it's got 90% silver in it is junk silver. So for those of you who bought 100-ounce bars 3 years ago, 5 years ago, 15, 20 years ago, because it was the cheapest form, it was the cheapest form because it's the poorest form. Your 100-ounce bars are not going to work for you when the system goes down.
Will they come after our silver like they came after our gold back in the early 1900s?
Well, they didn't ever come after our gold. I mean, I think there was a dozen people got fined or had jail time. There was no door-to-door knocking. There will never be door-to-door knocking. Can you imagine how many deaths there would be the first day if you had federal agents going house to house? Give me your gold, give me your silver. I mean, there wouldn't be out in rural areas, there would not even be a discussion. There would be a gunshot, the door would close, and that would be that. I do want to mention, you said about the Great Taking takes place, and that's not a Mad Max scenario. I disagree with that entirely. As soon as the Great Taking starts to take over and people are realizing that they've lost everything, you're going to have absolute anarchy. And by definition, I mean, it's going to be a Mad Max world.
What are some of the big takeaways one can have to arm themselves and prepare for, number one, a great taking, and then number two, the subsequent Mad Max that would come after it.
Well, you get your assets into a position where they can't be taken. If you own stocks, get the certificates. I mean, owning bonds is a fool's game because no matter what happens, the debt's going to go to zero anyway. I mean, you're not going to get paid back. But if you've got big, large bank balances, buy gold. That's out of the system. It can't be taken from you unless they come and take it from you. So your preparations is to get out of the system. That's one preparation. The other preparations are for your life. Do you have ability to have clean water? Do you have the ability to create electricity if the grid's down? Do you have food supplies? Do you have a way to protect your position? Well, first off, you need to be away from population. You need to make it difficult for 50 guys to show up at your front, on your property. So if you're more remote, you have better chances. And yeah, absolutely. You need probably a dozen people at least. Because you've got to sleep. There's work that's got to be done. I mean, you can't do it all on your own. It's not doable.
No, not at all. Well, I mean, Bill,
somebody's got to have your back, and you got to have someone else's back. That's what it amounts to.
The longer I watch this system, the clearer it becomes that we're not dealing with a cyclical downturn, a correction, or even a typical crisis. We're dealing with a structural bankruptcy, mathematical, moral, institutional, and political. The casino hasn't just run out of chips. The casino itself is insolvent. The tables are wobbly, the dealers are nervous, and the pit bosses are quietly signaling to each other that the doors are about to close. And the tragedy is that most people are still sitting at the slot machines believing the bright lights are real. That's why I tell people, cash your chips in now. Don't wait for the security guards to escort you out after the casino declares a temporary maintenance shutdown. Convert your fiat chips into something real: gold, silver, tangible assets, things that exist in the real world and are not dependent on counterparty promises. Because the promises are breaking. Look around you. Sovereign treasuries across the world are upside down. Debt to GDP ratios that once would have caused a global emergency are now considered manageable. Countries borrowing at 130%, 150%, 200% of GDP. And somehow the mainstream still pretends this can continue indefinitely. But debt compounds, interest compounds, reality compounds. And when the math stops working, every institution built on that math collapses right behind it. People talk about systemic risk like it's an academic concept. But systemic risk is simple. It's when all the tables in the casino shake at the same time. It's when everything that was built on leverage, derivatives, and trust starts to tremble. That's where we are. The global banking system is sitting on an inverted pyramid, hundreds of trillions of dollars in paper claims, resting on a relatively tiny base of real assets. The derivatives market alone is a $1 quadrillion black hole, an amount so large that even saying it out loud feels like science fiction. Yet it's real, and it's interconnected. When one corner of that pyramid breaks, the entire structure shifts violently. The last time this happened was 2008, but back then the central banks still had ammunition. Today they're out of bullets and out of credibility. All they have left is the printing press, and even that is losing its magic. The money itself is failing. When the unit of account is fraudulent, everything priced in that unit becomes distorted. Stocks, bonds, real estate, none of them are actually high. They're simply priced in dollars that are sinking. If a currency loses 30% of its purchasing power and your stocks go up 25%, congratulations, you lost 5% in real terms. But people cheer as if they're wealthier. This is the trick the financial establishment plays. They measure your lifeboat by the rising water and tell you you're floating higher. And let's talk about junk silver, because the irony is almost poetic. For decades, people ignored it. It sat in bags in basements and bank vaults, considered old-fashioned, inconvenient, uninteresting. But junk silver has three qualities that nothing else in the monetary sphere can match. First, it's divisible. 14 circulated dimes equal roughly 1 ounce of silver, which means you have the ability to make small, individual transactions in a system-down scenario. Second, it's recognizable. Everybody knows what a dime or quarter looks like. No assay needed, no testing, No complex verification. Third, it's uncounterfeitable. Nobody's going to fake a 1957 Roosevelt dime with scratches and pocket wear. That's the beauty of circulated constitutional silver. Age itself becomes the authentication. And right now, because dealers are drowning in legacy supply, junk silver is trading at the lowest premiums I've seen in over a decade. Sometimes it's spot, sometimes below spot. That's not a long-term condition. It's a short-term bottleneck. The refiners are backed up. The dealers don't want the inventory, so they're melting it for wholesale silver. That's destroying the remaining supply of constitutional silver. What you're buying today may be irreplaceable in 5 years. Once it's melted, it's gone forever. And in a system failure scenario, one circulated dime will be worth more in utility than a 100-ounce bar sitting in your basement, because you can transact with it.
Gold was overbought. Silver was more overbought than it was in 1980, back at the peak. And what you see with both of them are high-level consolidations. The paper trade is waning and the physical market is growing. The physical markets are growing. Just look at what the BRICS are doing. I mean, they're opening storage facilities, refineries. They're very serious about accumulating both gold and silver. And it makes sense because, years and years they had, I guess the metaphor is tons. They had tons of dollars on their books, and now they're adding tons of real money on their balance sheet. Well, obviously, price tells you that they're losing control, but let's not even talk about price. We did mention that we're in a structural deficit. We've had a supply and demand deficit for 5 years, and that's what happens when you get a small market size-wise as far as dollar amounts. I mean, the total production globally is only like $30 billion a year. But when you get a small market that's easy to manipulate, and if you're constantly manipulating to the downside and suppressing the price, what that does is it makes it much more difficult for producers to earn a profit, so they mine less silver. So, a direct consequence is the fact that we're in a structural supply deficit. Other things to look at, you can look at the lease rate on silver, you can look at the lease rate and the amount of shorts available on SLV, which is strictly paper, that's not actual physical silver. But the rates to borrow, it's blowing the shorts. The shorts are being blown up.
Once this thing really pops off, I mean, where is this gonna go?
No one can tell you that. And if they do, they're making up a number. I've said for years that on gold and silver, the numbers that we're going to go to are higher than anyone has projected of any number for gold or any number for silver. The actual number, I'm convinced, is going to be far higher than the most optimistic projection there is. And the reason being, gold and silver what they've done is they've sold paper contracts against gold and against silver that don't exist. We're going to move into a failure to deliver scenario. And when that happens, man is a funny animal. When you tell man he can't have something, he wants it that much more.
Yeah.
And I mean, you're talking literally trillions of dollars that are going to be dislodged from the stock market, from the bond market, even from the crypto markets. And all that money is going to be pointed toward gold and silver. Those markets, I mean, especially silver being so small, they cannot handle the type of capital that's going to be heading toward a safe haven or the safe havens. And one other aspect of man, fear is the greatest emotion there is. And people are going to be moving money into gold and silver, not out of greed because, I can buy gold at 50 and I can sell it at 100 or 200 or whatever. That's not going to be the motivator. The motivator is going to be fear of losing everything in other markets and putting that money into something that is a safe haven and cannot bankrupt. That's the whole key. They can't bankrupt in a world that is defaulting.
The biggest lie in modern finance is that the system is strong because the stock market is high. That's like saying a skyscraper is sturdy because the top floor looks polished. Nobody bothers to check the foundation because the elevators still work. But the foundation is cracking, and the first hints of the collapse are visible to anybody who watches the plumbing, where liquidity flows, where collateral is strained, and where confidence evaporates quietly before the headlines catch up. And the most dangerous crack forming right now is the unwinding of the greatest carry trade in human history, the yen carry trade. For more than 2 decades, Japan maintained zero or near zero interest rates, creating an artificial ocean of free money. Investors borrowed in yen at 0%, converted those yen into dollars, and then piled into every asset class on Earth: US treasuries, stocks, real estate, emerging markets, even crypto. It was a global subsidy, a distortion machine, a geyser of liquidity that kept asset prices inflated beyond any rational valuation. But like every distortion, eventually it reverses. Japan raised rates. The yen strengthened. Suddenly, the trade became uneconomical. And here's the problem. You're not talking about billions. You're talking about trillions. Japanese pension funds alone hold over $1 trillion in US treasuries. When the yen strengthens, they must sell treasuries to convert back. When they sell treasuries, US interest rates rise. When US interest rates rise, the debt bubble trembles. And as treasuries fall, anyone who used them as collateral starts to get squeezed. This is not a margin call, it's a chain detonation. Imagine the global markets as a gigantic balloon that's been kept inflated by a constant stream of cheap yen. Now imagine somebody suddenly turning off the valve. The air doesn't leave quietly, it rushes out violently. Assets that were artificially pumped up begin falling. Falling prices force selling. Forced selling causes more falling. And the circle feeds on itself until the balloon is a tangled piece of rubber on the floor. That's what the carry trade unwinding represents. And it's happening right now. People have no idea how big this is, because financial advisors, the very people entrusted with protecting wealth, don't understand it themselves. I've met advisors managing billions who cannot explain the yen carry trade. They cannot explain counterparty risk. They cannot explain what happens to a market built on zero interest leverage once the leverage reverses. They cannot explain how derivatives cascade when underlying collateral falls. They're brilliant at presenting pie charts, but clueless at understanding systemic fragility. And this is where the average person is betrayed. They trust people who don't understand the system. They trust institutions that don't even trust themselves. They trust validators who don't hold a gram of gold, yet tell their clients it's barbarous. They trust banks that openly classify depositors as unsecured creditors. They trust a regulatory environment that legalized bail-ins and quietly prepared the legal framework for the great taking. But here's the truth. The people at the top already see it. The central banks are buying more gold than at any time since the late 1960s. Sovereign wealth funds are diversifying aggressively. The ultra-wealthy are buying land, metals, rare hard assets, private vault storage, and anything that can't be digitally frozen. They're not shouting about it on CNBC. They're simply acting. Actions always reveal truth long before words do. The ordinary investor, meanwhile, is still sleepwalking. He sees stocks rising and thinks things are fine. He sees the dollar strengthening relative to the euro and thinks the dollar is strong. But that's the optical illusion of relativity. The dollar can rise against the euro while simultaneously collapsing in real terms. It can rise in the foreign exchange market while losing purchasing power at home. A currency doesn't have to be strong to appear strong. It just has to be less weak than the currencies next to it. That's what's happening right now. The dollar isn't strong, it's simply the cleanest dirty shirt in the laundry basket. But that laundry basket is full of holes. We're entering a period of multi-currency turbulence, a decade where currencies surge and crash, not because of strength or weakness, but because of instability. Debt levels, demographic collapses, energy shortages, supply chain reallocations, geopolitical realignments, and technological disruptions are creating a perfect storm. In the 1970s, the dollar lost 75% of its purchasing power in a single decade. And that was before we had $34 trillion in debt, before derivative exposure reached the stratosphere, before unfunded liabilities surpassed the GDP of multiple continents combined. People ask what to expect. Expect volatility, expect confusion, expect policymakers to blame outside forces, expect governments to alternate between inflationary stimulus and deflationary crackdowns. Expect narratives to shift weekly. Expect the media to tell you it's transitory, it's temporary, it's contained, right up until the moment it breaks. The only thing you shouldn't expect is stability. And inside this chaos is where gold and silver shine. Not because they go up, but because they survive. They don't rely on electricity, digital ledgers, trust in institutions, or permission from custodians. They're the only monetary assets with no counterparty risk. Everything else is someone's promise. Gold is a fact, and silver may be the most asymmetric opportunity of our lifetime. The spread between silver and gold is approaching the levels that historically mark explosions. When silver outperforms gold on a relative basis, it tends to do so violently. Ratio reversions are not gentle, they snap. And the technicals show that silver is pressing against multi-year resistance levels that once breached could lead to a vertical move. And this doesn't even consider the industrial demand. Solar panels, electronics, AI infrastructure, electric vehicles, military technologies. Silver is unavoidable. You cannot build the future without silver. You cannot build warfare without silver. You cannot build energy transition without silver. And the mining supply is collapsing. Secondary silver production is drying up, and primary silver mines are rare. Silver is literally the only major commodity on Earth where demand is rising while production is falling. And that's before factoring in monetary panic. When people panic, they buy silver before gold because it's cheaper and psychologically accessible. The mainstream will tell you silver is volatile. Of course it is, because it's undervalued. Undervalued assets move violently when reality reasserts itself. The next major move in silver will not be subtle. It will be violent, obvious, and irreversible. Meanwhile, quantum computing has begun to cast a long shadow over digital assets. When the founder of Ethereum stands on stage and says that quantum breakthroughs could compromise cryptographic protection within 2 to 4 years, that should send shockwaves. Quantum computers don't break systems like burglars. They solve problems with speed that collapses the assumptions holding digital security together. The Willow quantum processor achieved in minutes what supercomputers could not do in billions of years. That's not an incremental improvement. That's a paradigm shift. That's the equivalent of someone handing you a device that can decode every lock in the world. If Bitcoin and Ethereum are built on encryption that quantum computing can tear apart, the implications are catastrophic for digital wealth. And yet people put their entire net worth into assets that exist only as mathematical signatures. No criticism to crypto. Innovation matters. But digital assets are digital risks. You cannot diversify system risk inside the system.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.